recent years, there has been a much greater demand for businesses to behave in a socially responsible manner. A concept of capitalism is shifting. It had seemed that businesses must decide whether to prioritize on profits or principles. This does not have to be the case. Socially responsible business behavior can generate value not only for the stakeholders of a business, but also for those primarily concerned with financial gains, the shareholders. To understand this, it is important to consider why shareholders invest in firms and how this relates to shareholder value. There are two key reasons why shareholders invest in firms. Firstly, to reap payments in the form of dividends, and secondly, in the hope of a capital increase. That is, an increase in the price of the shares, meaning that when the shareholders sell their shares, a profit of margin will be achieved, as the price which they sold it for is greater than that of which they purchased it for. So, what is shareholder value? The simplest way to answer this is to look at how shareholder value is generated. If a company's market value increases, then shareholder value is created. Even more so if a long-term sustainable capital increase is generated. The key point here is that shareholder value is predominantly dependent on a company's share price, which in turn is primarily a reflection of a company's future cash flows. Subsequently, to create shareholder value, a company must ensure that the investor's perception of the future cash flows is a positive one, requiring firms to adopt a long-term focus for their companies. It is here where shareholder value can be generated and social responsibility can play a role. There are various ways of increasing shareholder value to satisfy the financial demands of shareholders. However, the approach of employing social responsibility as a means of doing this is certainly favourable. Not only does this produce quantitative financial returns, but such an approach also complies with high moral standards and responsible company values. To incorporate this approach, investors look to integrate environmental, social, and governance issues, known as ESG measures. This means that companies involved in sustainable stock indices practice corporate social responsibility in one of these areas. The benefits in investing in one of these companies is quite clear. A recent study by Oxford University, in partnership with Arabesque Asset Management, revealed that the shareholder value of companies who integrate ESG measures into their strategies is greater than for those that do not. These positive results can be explored in even greater depth. With regard to the environmental measures, the research revealed that companies associated with positive environmental news see an increase in stock prices by 0.84%. And the converse is also true. Firms behaving in environmentally damaging ways see a decrease in the value of their stock by 0.65%. Likewise, firms emitting high levels of pollution or those that violate environmental regulation also see a decrease in market value. On the social side of things, research has revealed equally positive results. A review of the 100 best companies to work for by London Business School revealed that the share price of companies who scored highest with regard to employee well-being well exceeded their industry average by 2.1%. Positive results also emerged from the governance aspect of social responsibility. Oxford and Arabesque's research highlighted that superior governance leads to better financial performance. And to quantify this, a portfolio dominated by well-governed firms earns an alpha 10 to 15% above the industry average. The real world of corporate business exemplifies these findings. In 2010, the Mexican Gulf suffered a horrific oil spill at the hands of BP. As well as costing the company $95 billion, the catastrophe severely affected their share price, and with this, the firm's shareholder value. On the 15th of April 2010, 4 days before the incident, BP's share price stood at 653p. Yet after the disaster, the share price tumbled by over 50% to 308p, and has continued to underperform its peer group by 37%. What is really significant about this is that the share price BP reached as a result of this crisis was lower than that it had experienced during the financial crisis, highlighting the importance of social responsibility to a firm's share price and with this its shareholder value. Although perhaps not as drastic, a similar incident occurred more recently. When the US Environmental Agency announced in September 2015 that Volkswagen had falsified emissions tests, the company's share price decreased by approximately 40% in the space of a month. Volkswagen's share price in this situation also reached lower levels than the company had experienced during the financial crisis. Whilst irresponsible social behaviour negatively affects companies' share price, a strong social responsibility policy can generate an increase in share price, in turn creating shareholder value. A good example of this is the Parnassus Endeavour Fund. The fund only invests in companies which meet their stringent criteria of offering an outstanding workplace and must not be engaged in the production of fossil fuels. The criteria produces spectacular results. The fund has consistently outperformed the S&P 500 index over the past 10 years, and since its founding in 2005, has earned a total return of 12.4%, almost 5% greater than that of the S&P index. Notably, the fund was also not as badly affected during the financial crisis as the grouping. With the understanding of how social responsibility affects shareholder value, it is time to consider why this is. The predominant linkage between shareholder value and social responsibility is that of sustainability. 80% of the studies by Arabesque and Oxford show that stock price performance of companies is positively influenced by sustainability practices. The reason for this is that to act in a sustainable manner, companies must take into account and plan for the future, meaning they must adopt long-term strategies, which is a crucial aspect of creating shareholder value when you consider that it is future cash flows that determine share price. In line with sustainability is that of a sustainable brand image. Building a positive brand image attracts investors to a company, as this is a means of fortifying future cash flows. Yet in order to develop a strong brand image, it is often essential that a company behaves in a socially responsible manner. To act in a socially responsible way, firms must also consider the interests of their stakeholders, primarily their employees and consumers. It is a respected view in the discipline of management that satisfied customers are the source of all profits and shareholder value, which is true, since if customers are satisfied with the company, they are likely to develop brand loyalty, a trait that enhances the future cash flows of a firm and with this, share price and shareholder value. In order to achieve this, firms must respect and score well in employee well-being. Furthermore, treating employees in a socially responsible manner also ensures companies retain their best talent, enabling them to maximize their productivity and efficiency, in turn aiding cash flows. Social responsibility, or a lack of it, also affects shareholder value through its impact on a company's finances. In a positive manner, the sustainable policies responsible companies use and transparent governance approaches practiced by these companies is viewed by banks and lenders as a method of risk mitigation. Subsequently, socially responsible companies can benefit from a reduced cost of capital, in turn positively impacting their future cash flows and as such their share price and shareholder value. What my aim today has been to bring to the forefront an alternative to the stereotypical view of business behaviour and capitalism as an immoral, socially destructive force. It is no longer a necessity for a business to choose between honouring its responsibilities to its stakeholders or shareholders. The social awakening of shareholder value means both groups can coexist. In the 21st century, companies cannot differentiate between shareholder value and social responsibility. The success of the former is dependent on the adoption of the latter. In today's world of corporate business, generating money depends on the practice of morals, and profits are driven by principles. Thank you.